right, welcome to the Risk Reversal Podcast. I am Dan Nathan. This is the illustrious Steph Guild. I think you all know her. And the man, the myth, the legend, this would be Mike Obucina. Mike is the head of education, and this is the CIO of Robinhood. I'm really excited to be here. There are so many folks here. How many do we have here, Obi?
I think we've got 1,100 attendees, about 800 or so customers, live in person, in the flesh. We love it. It's always great.
Hood 2025. I was here for Hood 2024. This is bigger. This is better. Steph, last year, you and I did a couple talks together. It was a big...
For the first time.
Yeah, we did, actually. And then since then, you've been on the podcast. You've been on CNBC with us, which has been a lot of fun. You become a mainstay on CNBC. I look up, I see Steph Guild quite frequently. We got a lot of stuff to do here today. The markets, all-time highs. I mean, how about that, right? And we have, yields going lower for the first time, testing some levels. We have a dollar going low. We're going to hit a bunch of the macro stuff. But I think we have to start with what's going on in the aftermarket today. I don't know if you guys are long Oracle, but if you are, you're doing pretty well. It's up 22% in the aftermarket. This is one of those names that has been a kind of late addition to the AI party over the last, call it 6-7 months or so. And when you see a stock like this that closed very near an all-time high, had a $680 billion market cap, and it goes up 20% on something very fundamental. Now, the quarter in and of itself was okay. I mean, it wasn't great, right?
Underperformed EPS, underperformed cash flow. They're actually negative cash flow.
Right.
Doesn't matter.
All right, but isn't this saying something about the market that we're in right now? They guide towards fiscal year 2026, which for them starts right now. Okay,
Yeah.
so it's not a calendar year.
Right.
So they're in it. You might say that maybe they have some pretty good visibility, right, as they start the year. But Steph, talk to me about the sentiment that must exist, right, when a lot of these other AI-related stocks, some of the biggest names in the market, have stalled out since their earnings. If you look at NVIDIA, if you look at Palantir, you look at Microsoft, it looks like there's been a big rotation. Why now Oracle, based on a full-year outlook that we don't know if it's going to materialize or not?
I mean, my take is that a lot of the other names in the AI space, like NVIDIA, expectations were already really high. Like, expectations are everything when you're investing.
Yeah.
And I think Oracle is the kind of name that people just don't think of first. Still, I know that it's been up and coming and doing better recently, but I still think it's like Oracle. Oh, that's like a tech company from the 90s, right?
Yeah.
That's what, but they are actually up and coming. They just picked huge, 3 big customers worth billions of dollars in contracts. And I think they're just, expectations were still not high enough when it comes to their future. And that's what the stock price is saying, is that the future is going to be better than the past.
When you talk about the future, this is a 50-year-old company, right? So this is you could throw it in there in the IBM category, that sort of thing. And so it is one of those ones where I think sentiment has not really caught up to the fundamentals. And you're getting that in one fell swoop. Obi, when you think about the options market, you think about how folks were positioning. I know that options are a huge part of your transactions or your volumes here at Robinhood. What sort of setups did you see here?
Yeah, the implied volatility going into this move was an expected move of about $25, $30. And the realized move in the aftermarket now is almost $75?
Wow, yeah.
So that's between a 2 and 3 standard deviation move, which means if you bought premium going into this as an earnings trade, you did well today. Hopefully tomorrow the open stays near here. We don't get a gap back down. If you were a premium seller, you think, typically options traders are selling elevated volatility going into a print like this. This is one where you can kind of get your face melted off on a move like this. So
when you say selling premium, though, you're talking about selling a put or selling
it could be a number of things. A more advanced options trader might sell a straddle, sell a strangle, sell an iron condor, because they think the move's going to stay within a range. Here we have a move blew through that roof, and now we've got the stock up almost $75 in the after hours.
Yeah, when you think about that, Obi, I often will go and look, and there's nothing scientific about this, people, but I'll go and look and see what the average move has been over the last year or the last 2 years. This stock and the next day after earnings over the last couple of years has been moving dramatically. Last quarter was up 13%. Last quarter before that, down 3%. Quarter before that, down 7%. But then 3 quarters in a row, up double digits, 11%, 13%, 12%. These are moves after the report. So when you think about that implied move of 10% in this one, it just goes to show you that market makers, or the folks that are kind of making the prices there, were a little worried about the potential for an outsized move. So, all right, let's just kind of put a pin in the Oracle conversation. Again, I highlighted the fact that Microsoft, NVIDIA, Palantir, a handful of other names, Taiwan Semi was another one, all associated with this generative AI trade. All of them have accrued most of the market cap gains over the last 3 years. We're talking about trillions and trillions of dollars. So, Steph, when you see a name like this join the party, does it tell you that it's broadening out? Do you think this is a healthy sort of thing if you're looking for a rotation? If there's only so much NVIDIA you could buy, there's only so much Palantir you could buy, is this why we're seeing this excitement?
I mean, I hope so. Like, I was calling for 6 months ago, being like, oh, it's software is the next thing, like the databases are the next thing. And it wasn't happening right away. But if it doesn't happen, then it's an old internet, late 1990s internet trade that needs some time to percolate. If it's happening now, which I say, I know we wanted to put a pin in Oracle thing, but what they talked about I thought was super interesting is that they're letting anybody use any LLM they want on top of their database. So it's a very flexible business, and that's what you want to see. Ali Goatsey was on one of the CNBC shows yesterday, and he was like, I wasn't that bullish on AI, and now I am, because you're starting to see it come into the fold.
All right, so this is a really good opportunity to talk about. All right, so Databricks is a company, I think it was last valued. So that Ali Goatsey is the CEO of this company. It's been private now for 6 or 7 years. And, it's got a $50-60 billion market cap, like I just mentioned. And, one of their main competitors is public, is a company called Snowflake. Yeah. They're outperforming this company in the private markets than Snowflake is in the public markets. Obi, you look at the calendar, you look at all these names that are private, you look at the valuations that are being accrued to them in the private markets. When are we going to see IPOs pick up here? Because I think a lot of folks are getting sick of hearing that stat. There's only 3,700 publicly traded companies. There are more ETFs out there than publicly traded companies. The number of publicly traded companies have been cut in half over the last 10 years. Are we going to see the IPO market pick up?
I think we're already starting to see it, right? We had Circle, we had Figma, a few others. CoreWeave, and luckily Robinhood is another product that we've democratized access to, is the IPO market. Yeah. So our customers luckily were able to get pieces of those IPO, and I think internally, Steph, you can probably attest to this. There's demand for IPOs. There's demand for these companies from retail traders. And so I would say I think it's already happening.
I think the one thing is that there's so much still liquidity in the system. Yeah. Like, broadly speaking. So that's why
despite rates being where they are, but the anticipation of them coming down.
That, and also just a lot of wealth has been built up over the last decade plus. And so there's still a lot of liquidity for the private companies to stay private longer. But to Obi's point, I think it's going to start changing.
All right. Little announcement here. You got a question? There's a mic right there. We're going to take him. Just go up there. Well, whoa. Right out of the gate. I thought we were going to have to call on Kelsey in the front row here to get things going. All right. What's your name? Where are you from?
My name's Sonny. I'm from the D.C. area, Northern Virginia. Watch you all the time on Fast Money. So
welcome.
Tell Tim I love him, by the way.
I'm not going to tell Tim anything. I mean, Tim's not here. I'm here. No, I'm just saying.
So the question is, when the private companies do come out and do the IPOs, do you think most of the money is already made on them in the private sector, or do you think there's still room to run, right? So thinking, they're talking about Databricks, Anthropic, OpenAI. OpenAI has already got a $500 billion valuation.
I'll start there. So one of the things that I find interesting about the IPO market, what's different, I don't know. I got this thing here, people. You think I know how to do this by now. What's interesting about the IPO market right now is that there's what they call growth funds that exist. They're at some of the biggest mutual funds on the planet. Fidelity, Wellington, all these companies have funds that are buying these companies in the private markets right now. That's a very different dynamic than what was happening 10, 20 years ago. And so you have to ask yourself, who is the incremental buyer on an IPO? predominantly retail right now. And I think, when you think about retail's ability to kind of speculate, I think it's there. And when I say speculate, are they doing the sort of work that a large hedge fund or pension fund or mutual fund is doing when these companies are going on the road shows? Probably not, but what we see here is that you guys have a lot of information, a lot of analytics at your fingertips, which is helping change that a little bit, right? So you guys are going to be able to make much more informed decisions. So we haven't seen an onslaught just yet. I think it's important to kind of look at some of the post-IPO moves that we're seeing, right? So you see a pricing by the investment bank, then you see where it opens. On some of the major ones that Steph just mentioned, you're seeing huge one-day pops, right? And so what have we seen since then? We've seen a lot of these companies come in a lot. So when you're participating in IPO, maybe you didn't have any allocation on that, but you want to buy CoreWeave or you want to buy Bullish or some of these other names, you got to be really careful about how you're buying them in the aftermarket. The last thing you want to do is put a market order on a stock that's priced at 38 that's opening at $80. And you may say, well, that sounds ludicrous. That has happened on numerous occasions over the last few months. And if it opens at 80, sometimes it goes to 150. So Steph, talk to me a little bit. Who is that incremental buyer of an IPO?
I mean, I do think it is the people who don't necessarily have natural access to it. So I do think it is the everyday investor. But I thinking about your question, though, I would say you can go back in greater history and see that, like, initially the IPO, it rallies and then it sells off. You can think Meta, right? Like, if it wasn't like a great buy right away, but it eventually became a great buy. Google was kind of the same, like when it first IPO'd. I remember the analysts I was working with were like, don't buy the stock. And the PMs were like, we're going to buy it anyway.
Well, and the size of the deals, though, I think is really important. These were like hundreds of millions of dollars in market cap, not
now it's billions. I mean, everything is bigger, costs more, even eggs. So I would say that you can be patient, but I do think that there's value longer term. But just like I always think about the quote about like cars and like who was going to be the best car maker, right? Everyone's trying to make the first car, like along with Ford, and only Ford was the one that was like, I think AI companies are going to be the same. So that's something, like, not all of them are going to make it. Some of them will get, merged together. But I think you just want to be like careful about like your sizing.
Yeah, the famous Warren Buffett quote in like 1900, we knew cars were coming. There was hundreds of car makers that were trying to build the next big thing, and only 3 lasted, right? The big 3. So the theme is obvious. The question is, who will the winners and losers be? And to your point, Dan, just if you have access to an IPO or there's that momentum feeling that, this stock's starting to take off, you got to be mindful of your trade size. When are you going to take some off the table? How are you going to manage your risk? These are all things that retail traders tend to learn the hard way. And so you just always want to be mindful of that and not put all your eggs in one basket or think something's going to continually go up. Learn how to kind of take profits along the way and manage your risk so that, like in the example of Figma, popped to 140. Now it's trading $53, and that's in a matter of weeks.
Yeah, and so Figma's priced at $38. It opened at $84. It went as high as $142 or so on the third day or second day of trading. And to Obi's point, it's at $53 right now. Here's something, this is a little trick to also pay attention to. So the companies go on these road shows, the weeks before the IPO, right? And they're telling a story and they're giving guidance and they're trying to be really optimistic. If they are not, they should not be going public.
They're on a sale. It's
right.
on a sales.
It's a sales
pitch,
right?
Call.
And so usually companies will leave a little something for that first quarter when they report. Figma did not do that, okay? And the stock was down, I think, 18% or so. This was last week at one point. And so this, to me, is not signaling something that a lot of folks are hoping for in the IPO market. If companies are disappointing right out of the gate, maybe their core businesses are not ready there. Maybe they're actually too mature, where you're not seeing that growth. There's a couple different ways to think about it. How are you thinking about that, Steph? When you see a stock, 38, 140, 53, we're talking about less than a month or so.
I mean, it's none of it, if it's that short a time period, none of it is real. Like, you just really have to look at the core business, look at earnings, and just say, what do I believe this company is worth over the next 3 to 5 years, and what are their growth catalysts? Yeah. And forget the short-term noise. The short-term noise to me is you can play it with options, you can if something pops, take some profits, play with house money. But obviously if it's appropriate for you, but it's something that I think you just need to really, in the IPO market, you want to think long-term, not short-term.
Yeah, and I want to make one point about this company. So I don't know if you guys remember, about 2 years ago, Adobe, one of their big competitors in collaborative software, tried to buy them for $20 billion.
Yeah.
Now, some of the regulators, I think in Europe, they kind of decayed the deal. But the stock now is trading at a $26 billion market cap, and I'm sure they wish they could have done that deal, been gobbled up by Adobe.
Adobe's been struggling.
And Adobe's been struggling, partially because companies like Figma were meant to start to eat their lunch a little bit. Figma doesn't really have that AI story. Adobe it's been cut in half because of that. Adobe
They're
reports
such a frustrating company, though.
Well, yeah, well, it is, and there's a lot of these.
They have all these like assets, and I'm like, what are you doing with them?
Yeah, well, it's kind of like a melting ice cube if you think about it, right? So let's just talk about Adobe for a second. Steph, you said something about the next leg of the generative AI trade is likely to be in software. We talk about the application layer, right? What are the companies building on top of these large language models, right? What are they going to be able to sell to their existing customers, upsell them? That's been the promise of a lot of these enterprise software companies. If you look at Salesforce, I think a week and a half ago, they are not able to tell that story about their customers.
I put them in the same camp as Adobe.
Well, right, but if there's any company, their ticker is CRM, Customer Resource Management. That was one of the first places that people expected generative AI to be useful towards enterprise customers.
And they keep saying it's coming. It just hasn't showed up in the results yet. Right. And I think, the market, investors, they lose patience with it. My prediction is at some point they will outperform expectations, but the expectations had still been elevated on the promise of their agent force, I think is what their product is called, is to really deliver. And it hasn't really yet, but they keep saying it's coming. So it's one of those ones that's equally as frustrating as Adobe. I think you're getting, like, Pure Storage to me is a name that has actually started to benefit from the AI trade, because you need data storage.
Last year, is that right? Or
I think it was 2 years ago.
Yeah.
But they just had a big pop in their post earnings. That's where you're seeing like the benefit of AI, and it's you need a place to store this.
Yeah.
And the same with Databricks, Snow, like you need that stuff.
Right. And I just want to make one point about a Salesforce, right? So this is a company that's down, I think, 20% on the year, right? So if you look at a bunch of these enterprise names that we've been talking about, they're all really underperforming the NASDAQ, right? And I look at a company like Salesforce and I say to myself, it's expected to have 11% EPS growth for the next couple of years. It's expected to have maybe 9-10% sales growth for the next couple of years. It has a gross margin of 80%, right? If they can ever start upselling, right, it's pure margin. That's where the earnings acceleration sort of happens. But trading at 22 times, you'd say this is an interesting name to play the back of it. Why is it not working?
Totally.
The stock, not the fundamentals.
Right. No, I mean, the why isn't it coming through in the growth of the fundamentals? That's what the market needs to see, is like, oh, what they think is going to happen is actually happening, and all they keep doing is disappointing every earnings corner. You're right. It's attractively valued. Like I personally would love to own this name, but I get frustrated with it.
Yeah. And I'll just say this. If, Obi just talked about it, and I want to get his take here a little bit about implied volatility, the price of options, right? I don't mean the price that you're reading on the screen. I mean, like, how much is pumped into that option, right? And so we know that option premiums rise into earnings because you have these events. Look at what's going on with Oracle right now. If you're a market maker and you misprice that option, you're going to have a really hard time tomorrow morning on the opening. You're going to get tapped on the shoulder by your risk manager. I've had it happen to me, by the way, people. So when I think about implied volatility, the price of options, then I think about historical volatility, how much it's moving. Obi, talk to us a little bit about the vol crush in Salesforce after the print. Now we've seen historical vol, how much it's moving, pick up a little bit. Is this kind of signaling that maybe if you're looking to take a shot at this, that maybe the story is getting a bit washed out? Are there some option strategies that would make sense in a Salesforce?
Yeah, so looking at Salesforce, if you guys use Robinhood Legend, I hope you guys are using it, checking it out. We launched the new widget this year called Snapshot. It's a widget that I absolutely recommend everyone put on their screen because you get your stock price, you get the summary of what's happening in the news feed, you get the fundamental data, but there's a tab called volatility. And in there, you can get two things. The 52-week range for implied volatility. Now, without going down in the rabbit hole of volatility, Dan, that's essentially the average 30-day implied volatility implied from the options prices. And you can see for Salesforce, we're sitting on the low end of that range. We're sitting at an implied volatility of 29% on a range of 26 on the low end, 60 on the high end, which puts that at an IV rank, which is sort of where in that bar is that, of 9%, which means we're on the low end of implied volatility, which, long story short, Salesforce options are relatively cheap. Now, compare that to Adobe, which we were talking about a few seconds ago. We've got an implied volatility rank of 85%, sitting at 48%, and its 52-week high 53%. So that means if I'm trading Salesforce, I may look to strategies where I'm buying premium in the hopes that implied volatility increases, which will increase the price of my options. If I'm trading in Adobe, I may look, whether I'm bullish or bearish, look to sell premium because that's on the high end of the range.
Yeah.
And historically, volatility is a mean reverting asset. So you have sort of an average volatility. And when it's on the high end, it tends to gravitate back towards the middle. When it's on the low end, it tends to gravitate up.
All right. By the way, we're going to nerd out tomorrow morning on options at 9 a.m. So we're going to take that down a little bit. So definitely show up for that. We got a great panel, too. You're going to be moderating that, and we're going to go through a lot of strategies. And I think you got some new bells and whistles to talk about a little bit on maybe Vlad's going to talk about that tonight.
Yeah.
All right. So we can't tell you what's going on, but there's a lot of cool stuff there. All right. So moving on from software, it seems to be an absolute train wreck. Maybe there's going to be some opportunities as you think about, that dogs of the Dow sort of thing. We don't trade the Dow. None of you guys trade the Dow. And some of the names
What's
in there.
the Dow? No,
right. But the whole idea is that as you get into, year end, some of these really underperforming stocks may start to outperform next year because investors who've been sitting with these things on their books, they may puke them towards year end, and other folks are going to see that as an opportunity. Let's switch gears here, okay? Because earnings season is pretty much done for the most part, but it actually starts again in a couple weeks or so. Let's talk about the macro because, it's been a big driver this year. A lot of the volatility that we had, in April had a lot to do with some stuff that no one really saw coming. I think a lot of folks expected some sort of tariffs. That was what was talked about.
Totally.
Into the
Not
election.
to the level.
Not to that level. The average tariff rate is about 18% right now versus 2.5% in January. Steph, how are you thinking about this trade war? Make no mistake about it. It is a trade war. It wasn't the sort of thing where it was a shot across the bow and there was a whole bunch of agreements and then we could all figure out what tariffs were going to be going forward. How are you thinking about tariffs at this point? Because some of the economic data that we're seeing, consumer confidence, and a handful of other things are starting to show some strain. And we could talk about the labor market, some strain from these increased tariffs because companies who have to pay them on imports either have to eat that and it's a hit against margins and a hit against earnings, or they have to try to pass it through to consumers.
Yeah. I mean, I think I was excited to have deals past us, and we were sort of thinking about once things sold off, buy into that dip because there will be deals coming. We like Japan, we like in advance of those deals. Now that the deals are done and there's some wariness around it, like in Europe, for example, the steel thing was kind of impacting the overall deal. I think now there's a couple of things that the way I'm thinking about it. One is that I still personally think the jury's out on whether it's going to cause inflation or not. And I do think it will be short-term versus long-term carried out inflation. But I personally believe there will be inflation from it, even though we haven't seen it in the data, because I think it's just going to start showing up now. This week's inflation is going to be important.
We have PPI tomorrow morning at 8:30 Eastern, and then we have CPI on Thursday morning. So let's just talk about this dynamic. We had the August jobs report on Friday. Make no mistake about this. The labor market is weakening right now, right? So we had a negative print on some of the revisions for June. So we have weakening labor market, we have sticky inflation, and we have GDP in the first half of the year. So that's economic growth at 1.4%.
Which is fine.
Oh, it's not fine. Steph,
Oh, come on. It's
What
fine.
we're talking about, that's the definition of stagflation. We have
1% GDP growth. No, not for developed countries like ours. I actually don't think the labor market is as bad as. Yes, the revisions are bad, but I feel like part of it is more the fact that like the way the BLS has been actually getting their data is so antiquated.
Oh, stop it!
It starts
Shoot
with
the
phone.
messenger. That's what you're doing there.
It
Come on.
starts with a phone call. Like,
I know, but this
who
is the way-
answers the phone anymore?
Well,
I'm just saying that I'm not saying that the labor market is growing by leaps and bounds, but I don't think that it's weakening as bad as everyone wants it to. I do think that inflation is going to come. I don't know how big it's going to be. We will get some data this week. But I definitely think that the Fed should still cut and have these insurance cuts is what I've been calling them. Like,
right.
I think it should be 50 to 75 basis points this year. And then let's see how it goes. If inflation comes stronger than possible and it does go into margins, then that means that the labor market's going to get even more soft.
Right. Well, the worry is when you have like rate cuts, okay? So the expectations, as Steph said, it's a near certainty we get a 25 basis point cut. That's a week from Wednesday, right, at the September 17th meeting. And then the real question is, are we going to see a series of cuts? And then you have to ask yourself, what are these cuts? Why are they happening? Is it because the economy is weakening?
No,
because we're going to...
You don't want that.
No, you don't want that.
Right. The reason is important.
Right. So, Obi, what are you seeing as far as, hedging? Are we seeing some hedging into these prints tomorrow, Wednesday, and then with the Fed meeting next week?
I'm looking at the VIX right now sitting at a 15.
Not a lot of worry there.
Kind of a
market
snooze.
does not worry about it.
So if you don't understand what the VIX is, essentially the implied volatility of the S&P 500, which says how much does the options market think the broad market is going to move. A 15 VIX is roughly about 1% daily moves, which is kind of ho-hum, right? Now a VIX of 24, that's okay. Something's happening. We get a VIX above 30. Now, like, there's panic, right? People are going to the options market, bidding up the price of those options. But Dan, I'm looking at my prediction markets hub, which is another session we're going to talk about tomorrow. So make sure you guys check that out. Fed decision in September, 25 basis point cut, trading at 80%. Number of rate cuts in 2025, flip a coin between 2 and 3. We got 39 cents for 2 cuts, 38 cents for 3 cuts. So I think the prediction markets are pretty much 2-3 cuts this year.
All right. How cool are the prediction markets? Are any of you guys doing that? Show of hands here. We got yeah? Pretty cool stuff. So,
I did it on tennis too.
You did? Oh, look at that.
I had some football picks this week.
Oh, did you really?
Yeah.
Like, it's kind of cool that you can do that on the app, right? You don't have to call some bookie and do some shade. No, I'm just kidding. Nobody's doing that. Again, that mic is for questions. Don't be shy. We want to take them. All right, so we got the macro here. Let's talk about yields really quickly. So the 10-year got down to this kind of 405 level or so. And, 4% is kind of psychologically important. Mm-hmm. When we saw the 10-year yield last year at 5%, folks were getting a little geeked up. They thought they were going to get through that 5% level and was taking off. We also saw a 5% level for the 30-year U.S. Treasury. That was something that was kind of spooking folks. That was speaking to potentially stickier inflation, right? Big deficits and debt.
Big deficits. I mean, I think that what's funny is that nobody in the stock market likes the tariffs. I think, it's not great, right? Yeah. It's not great for earnings. It's not great. But the bond market loves them. Because we do need to fix our deficit, and the bond market hates the fact that we have to borrow so much, right? So the fact that the tariffs are at risk by the courts, that the long-term rates will trade around that decision. But the fact that it's been coming down, I don't know if you've been noticing what's happening in rates. Like, our rates have been coming down, and that has been helpful. That obviously helps the stock market too, because the lower the rates are, the better higher valuations can be in the stock market. But in Europe, actually, rates have been going up in the long end. Like, there's a lot more worries.
Well, the UK looks like they're about to raise, and so those differentials I think are really important before we kind of get too deep in that.
It has impact on earnings for companies that are global. Like, you do have to think about that.
Well, so that's a great point. So 40% or so the S&P 500 revenues come from outside the U.S. So if you have a dollar trading the way it is, it's 98.5, the U.S. dollar index. That is kind of a tailwind for U.S. multinationals. The lower rates, like you talk about, it's also good for small cap. Steph, let's kind of just quickly lay out what your view for the S&P 500 is for the back half of the year. We're already well into the back half of the year. We have an S&P 500 that's up nearly 11%. We have a NASDAQ that's up about 13%. We had 2 consecutive years, 23, 24, up 25%. We know 95 through 99. Who was trading back then? 95, 99. This guy, well, yeah, I know you were. And, we had like 5 consecutive years of 25% gains or something.
It's the only time.
I mean, it's crazy, right? And then we got this blow off in late 99, early 2000, and then you guys know what we had. We had a protracted bear market. So, Steph, how are we thinking about this? Are we going to get 25% gains this year?
I don't think so.
You don't?
No, I think there's too many potential reasons not to have it. Look, my target at the start of the year was 6,500, and now we're there.
Look at you. Look at you.
I'm a little bit like, what's going to happen? So I was feeling like the S&P is going to be hard. It's going to be a little grindy from here. Doesn't mean there's not opportunities underneath.
Wait, a little grindy. I've been in the markets for 27 years. I haven't heard a little grindy.
A little grindy.
Grindy.
Like just hanging out where it is. Maybe it goes up a little higher. Maybe it drops back down a little bit. Not that it gives up a lot towards the end of the year, but the more opportunity is below the surface because the Mag7 is no longer the Mag7 to me. And I know I'm not the only one saying that now, but the Mag7 controls what the S&P does. And I think you got to look at the Mag7 like any other set of stocks.
Well, hold on. We've done a couple pods this year. It's the Faithful Eight, people. When Broadcom passed $1 trillion, we threw it in there.
Catching on.
I think it's caught on, by the way.
Okay, fine. Faithful Eight. I don't see a lot of I think that is going to have a hindrance.
So let's talk about this. Obi, I want to get to this. I want to see like what sort of flows you've seen. We've seen a big rotation just in the last few weeks. You saw what happened with Alphabet, right? We're seeing Meta very near its highs. Nvidia's hanging out, but it did. All right, so we've seen Microsoft, Nvidia, Apple has rallied, but still way off its highs. Tesla can't get out of its own way. We're going to talk about Tesla here in a second. Amazon's getting back towards those highs. So there's some bifurcation a little bit in the Faithful Eight. How do you think about that? That's a little grindy, don't you think?
It's grindy, and that's what I mean. Like the conglomerate to me is not going to move the needle.
Yeah.
It's going to be a lot of the other stuff underneath, things that maybe have better valuation. But not that like I said, you got to study each Mag7 as if they're their own stock, and you have to care about it that way. What is Apple doing? Is Apple cheap now?
Wait, can we talk about Obi? Give me your phone for a second here. So Apple just had their phone event. Have you ever seen a more beat up iPhone? This is like wait, what
He's
year is this? What year is it? You've been waiting 7 years for a new one.
Yeah.
What year is this?
There's a story. There's a story behind this. This is the iPhone 11.
Oh my God! They just announced the 17.
Yes.
People. I'm gonna say
he was waiting for that.
Yeah,
one.
I went into the AT&T store a couple weeks ago. They're like, just wait a couple weeks. So I had this for that long. Might as well wait another few
they've been
weeks.
saying that for 6 years to you, Ob.
Yes, this is the one. This iPhone 17. Yeah.
Okay.
So let's talk about Apple for a second because this was a darling for years and years and years, and it was a really interesting day. I think last year or maybe late 23, where Microsoft overtook Apple in market cap terms, and a lot of folks thought 3 years ago, 4 years ago, that would never happen, right? And then what did we see? It got dropped down a little even more, right? We saw Nvidia overtake Apple, then Microsoft. Now it's the largest market cap company in the world. Steph, how important are those large market caps? Forget what we were just talking about, like, the Mag7 or the Faithful Eight. It's a bunch of different stocks now. We might see a lot of differentiation because of the fundamentals of these companies, how much of the generative AI story they've pulled forward. What are some of the competitive sort of dynamics that have changed, like the Oracle that we just mentioned? How do you think about market caps? Are they important when you're investing?
They're important for in a couple ways. One is like if you're comparing yourself to the S&P, like that's really like it's that conglomerate that's going to like drive what the S&P does. So if you're comparing your trading to that, I think they're important too because they will set the stage for how people feel about what the market is doing.
Yeah.
But I don't think like market cap in and of itself is that important other than like just know that like whatever the larger the market cap, the more people are following the company and knowing the details of it. And there's very little new to learn that other people don't already know. Whereas like smaller companies, you can kind of like dig a little deeper and maybe find some things that you can put together and come up with an investment thesis a lot easier. But I think that to me is the most important thing as an investor.
Yeah, and one of the reasons why it's important to me, and I'm just going to kind of give a little exercise here. So Oracle, like we just said, it's up 20% in the aftermarket right here. And I'm looking at the members of the NASDAQ 100, the QQQ. Where can I find this here, Steph? It's not even in the top 10. No, it's not even in the top. You know, we have to kind of go into like 10 through 20 or something. And in the aftermarket, the QQQ, which closed at 581 or 580 or something like that, is up $1. It's not even moving.
No,
right. So there's a good example. Yeah. When you had Alphabet last week, which is what, a $2.5 trillion market cap company, move up 10%, that's going to move the underlying index. So that's, I guess, one of the things that you're kind of getting at. I think that is kind of important. Again, questions over here, people.
Dan, if I could just say real quick, I think for anyone trades SPYs, Qs, S&P, NASDAQs, right? If you're trading those options, trading those shares, you need to know what those big market cap companies are doing, because that's going to move your position. Yeah. So that's really the most important thing when it comes to market cap for me.
Yeah, I agree. What do you got here?
Hi, this is Hajime. I'm from Japan.
Hi.
Wait, did you come in from Japan?
No, actually. I live in New York, but I've been so I actually was traveling in Europe for like 1 month and then just came back last night at 8 p.m. Oh. And then from New York to here, I flew in the morning at 7 a.m. So I just got here.
Hope you got some sleep.
Oh, no.
Thank you for making the trip.
Yeah, of course. I have a question. So market is up in straight line for about like 5 months straight since Liberation Day. And market expectation is that interest rate cut chance is like 80 to 90%. Yeah. Do you think that's going to cause the sell the news event or the don't fight the Fed? And what should we be looking at to figure out when the pullback is coming? And question to you, Steph, what do you think will pull the market down? Because you were saying like, market will not be that high.
Ooh, that's a lot. Sell the news or don't fight the Fed. That's the first question. So for some reason my like inner voice is saying like maybe sell the news, because my concern is that everybody's like, okay, great, labor market is really bad, so that means we're going to get several rate cuts. And I do think like Powell at the very least is still concerned about inflation. We have to see what happens this week with the data and the CPI and the PPI. But I worry that like there's 3 ways that the Fed can do things. One is, buy treasuries in the open market, which I know that's being criticized now. And hopefully we don't have to do QE again for a long time. Japan does it. But then there's cut rates or raise rates, or it's just talk about things, their rhetoric. And what I'm afraid of is they'll come out, they'll cut rates by 25 basis points and then talk a little more hawkishly. And that's why I think I worry that it could be like sell the news. I mean, look, it's kind of 50-50, but I do think it could be, I lean a little bit sell the news personally. And I would love to hear what others think.
Yeah, I mean, a hawkish cut. You're getting the cut that you want, except that you're not getting a greater commitment to further cuts. Now, if you look at the CME Fed Funds future, it's not pricing a high probability of a 50 basis point cut. They're calling that a jumbo cut. I don't know, is that jumbo or not, relative to the 25 basis point. We haven't seen, I think, for most of the rate cutting and hiking cycles, let's call it over the last 20 years, I think it's predominantly been quarter point moves one
except
way or
in 22, I think they did a couple 50s.
So last year, and that was, also, I mean, during COVID and things like that. But last year at the September meeting, it was the first cut since COVID, right, 2020, and it was a 50 basis point cut. And it is interesting that right now they're worried about the labor market. Back then, a year ago, they were worried about the labor market. So you could ask yourself, why are they not cutting 50 basis points if some of the concerns right now are similar to that of last year? Maybe when we get this PPI or CPI, maybe it comes in
if it's
soft.
Cool, then
cool, soft, that sort of thing. Yeah.
whatever word.
Yeah.
You had other questions though. Besides, it was what do I think of the market from here, and when do I think the market, or when do we think the market could come down?
What should we be looking at to figure out when the market is going to come down?
Oof.
If only we knew.
If I knew that, I wouldn't be
on a
sitting
boat,
here.
yeah.
I'd be in my yacht.
You know, one of the things I like to look at is the options market, right? You can use technical analysis. That's always backwards looking. And technically right now, the S&P, you use the term straight up. I would say recently we've seen a little bit more sideways chop. So that's one clue that at least the market's taking a break and we're getting sort of tighter moves and more choppiness. But the options market isn't really screaming anything to me at this point.
Yeah.
With a VIX of 15, and even looking out through the end of the year, the expected move by the end of the year is $500 up or down. So that's a 68% chance that the S&P closes between 6,000 and 7,000 by year end, which is sort of right in your target.
Yeah.
One of the things I like to look at is if you get a day where the market's up, but you see VIX also up, that's an interesting sign, because typically market up, VIX down, market down, VIX up. But when you see both up, that usually means traders or investors are reaching for protection. And we use I like this analogy. When's the best time to buy an umbrella?
When it's
When
not
the sun,
raining.
when the sun is shining. And so the biggest mistake I see retail traders make is they ride the move up, and then when it starts crashing, that's when they reach for protection, and all those options are already overpriced. The best time to buy protection is when they're cheap, and if you don't use it, sure, it's going to hit your returns a little bit, but it's one of those things you just
Yeah.
yeah.
All right. So I'm going to
But
go.
just one thing I want to add is that September is not over, and
Yeah.
September is always the worst month in the year. I think I tweeted about it, but it was like on average going back to 2002, it's down 1%, and every other month is up. And that, so I'm like, September is not over. I'm actually like, would be very welcoming of a 10% or, kind of correction, not bear market, but correction this month. I don't know if I'm going to get it, because if inflation comes in soft, I don't think I'll get it.
Yeah.
If inflation comes in, then I think. we
And
get some
you've talked to
traction.
Tom Lee. He says we're still in like the middle innings.
Yeah.
Like,
What do you? I mean, Tom's bullish.
What is he not bullish?
Wait.
Wait, I used to
Newsflash.
work with him at JP Morgan. He's never not bullish. So,
Listen,
look,
Tom's
he's
a really,
right.
he's a
He's
really,
right.
really
He's
smart
been right.
guy.
Yeah.
He has been right. Here's one of the things. You're good, man. Take
Sorry.
a
Thank you.
breather. You're tired. Here's what I'm looking for about. We're going to get into earnings season, like I mentioned, right? So the back half of October, so about a month away. You look at a company like Oracle print the numbers or the guidance that they did today. Great. You know what I mean? They have not been able to guide that way in a very long time. So here's a company that's kind of catching up a little bit, and the stock obviously is having this huge pop and is being rewarded for that. But like we also mentioned, some of those other names have taken a breather since their earnings. That's really important to me. All right. So I want to think about how much pull forward have investors, kind of anticipated about the results that these companies have reported up until this point over the last few years, and what is the likelihood of the magnitudes of the beat continuing that way? What are the likelihood of the spend? They're spending, some of these big hyperscalers, the Microsoft, the Google, the Amazon, Meta, they're spending 25% of their revenue on CapEx. If you don't start to get the ROI, the return on those investments, then the multiples are going to contract. Then there's another thing to talk about. Apple had a really good quarter as far as iPhones this last quarter. Obi just told you he's waiting. The guys at Verizon told him wait until this new one is coming out. Well, why did a lot of folks run out, other than Obi, and buy iPhones? Because they didn't know what the tariff situation was going to be. So there was
they didn't know what the price was going to be of the new iPhone.
And there was a big pull forward. So now the question is, when we start to get earnings in about a month or so, are these companies going to see a deceleration in their growth because a lot of folks had already bought a lot of this product? To me, those two factors are going to be really important about how the market closes, how it performs in November and December. The last thing I'll say, I remember what happened the last year of those big returns that we talked about in the late 90s. The mania in and around the internet is very similar. Now, the names are different for the most part. They have revenue. These are companies that have moats. They have monopolies. They have great managements. They have great balance sheets. That's what's different. But you know what's not different? Sentiment. And sentiment and the way folks take risks is the same in every major market cycle, in every major, bubble. Now, the term bubble doesn't exactly mean it's about to blow. It doesn't actually mean that it's the most negative sort of thing. There's a lot of good things going on in this economy related to CapEx. But one of the things I think is really important, I think it was Torsten Slok from Apollo. He put this chart out. I'm sure you saw this a couple weeks ago, where 2/3 of our economy, 2/3 of GDP is consumer spending. We like buying stuff other than Obi when it comes to iPhones. I'm going to just keep killing that thing right there. Okay.
It's not even my phone. It's a buddy's phone. He lent it to me.
But for the first time in a very long time, we've seen capital expenditures from these major companies who are building out these data centers equal that of consumer spending. That is saying something about what's going on in this economy. That spend is driving a lot of performance in the economy, but it's also driving a lot of the earnings growth in the S&P 500. When you look X those 10 names, the S&P earnings for those 490 is growing at low single digits. So you could say, well, it's always concentrated. We always have these big names. It is a little different this time, Steph.
You think so?
I do.
I think one thing I worry about a little bit as you're like talking through it is that I've started to hear some people who've been in the markets for a long time.
You call me old? You call me old.
I feel like we're almost the same age. And anyway, that say valuation doesn't matter.
Yeah.
And that scares the
Adam Parker.
4-letter word, Adam. Yeah, that's who I was thinking of.
He wrote
That's who I was thinking
he wrote
of.
an op-ed in the FT this morning.
I was like, okay, come on.
They're always on Closing Bell together. It's great.
Oh, really?
We'll skip that part of the conversation.
He's a very confident market prognosticator. All right, so that is a really important thing from a sentiment standpoint. When you see well-regarded strategists like our friend over here talk in a way that they don't see things, they just see things continuing to go there, that like an unusual market sentiment can continue for a long time. I look at a stock, again, like Oracle, up 22% in the aftermarket. I look at sentiment where folks can see this thing going on, and I start saying to myself, I've seen this before. And, I'll just say this about late 99. We saw stocks like Yahoo and Qualcomm and Nortel. They went straight up. I mean, they went up in a straight line. The NASDAQ was up 80% in 1999.
Yeah.
Those are things they can continue for a long time. But
until they don't,
it's not a sort of bubble.
That's why I like mixing in things that are just not as expensive.
What's some of the boring stuff that you like? Let's hear. What are some of the sectors?
The boring stuff? Yeah. Well, I like playing other things. Like one of my investment thesis is like, what is the executive branch of our government doing? Yeah. And
you want me to answer that? No, I'm just kidding. That's for another podcast. That's not a
this is not a political
network.
question. Yeah. I'm serious. Like, I think there is a new paradigm shift in like the defense sector, defense tech and other parts of defense. So like that to me is like kind of interesting and attractive and a secular
But how do
theme.
you play it? See, this is a great example. The most innovative companies in defense tech are in the private markets. Look at these legacy names like Raytheon and Lockheed, and I'm missing one of them. Northrop Grumman. They can't get out of their own way. I mean, one of them's making highs.
Oh, no. RTX is making highs.
Well, I know, but Lockheed just made a new 52 after their name. So,
sure, yeah, some of them. But then you have some of the smaller. So I like playing in the like mid-cappy space in this. Like you got a company like Kratos. Now it's been doing really well. But they do the drones. Like I think it's more just like.
What's the ticker there?
KTOS.
Yeah.
Johnny on the spot over there. That's KTOS.
That like, that's why I've been like personally, I've been liking it in the space of like, I don't know exactly what to pick, although I have some opinions.
Yeah.
So if you don't want to do that, you can look at like an equal weight ETF, for example, that like plays in the space, because then you get a little less of that like Lockheed, Boeing, like kind of thing that's already been playing. You can see it's up a lot.
Yeah, so this is going parabolic. Yeah, so a year ago it was $20. Now it's got $11 billion market cap and it's trading at $64. And the thing that I have problems with stories like this is that the story wasn't too different a year ago. Like all of this technology that they were working on. The one big beautiful
bill. I think there's a lot more money being spent in the defense sector. That's why I think you like do a basket. You don't just pick one name. Like I was picking one because I was saying like this kind of fits that theme. You know, Huntington Ingalls shipbuilding company, like same kind of thing. And the CEO of that company came out and said, this is a paradigm shift for us because they've been kind of, you know, defense spending, like the government wasn't spending their money there. They were spending on Social Security.
Can we agree that's a bit niche-y, right? Like, so
but that's where the interesting stuff is. I like regional banks too.
All right, talk to us about regional banks.
Regional banks, like I think there's 3 to 4 legs of this stool. It's, you know, steeper yield curve. I think yield curve will remain steep. Fed starts cutting, long-term rates don't move much down. That's actually good for a bank in general because they, you know, lend deposits where they pay the short-term rate and then they make the long-term rate. So that's like you have this natural spread there. I do think like what has been the most regulated sector for the last since 2008? Banks, right? I think deregulation will happen there. You'll start to see some M&A activity there. I can't guess who's going to get bought or whatever, but I do think there's some like positive things happening there.
All right, let's talk about large cap banks. Jamie Dimon today, the CEO of JP Morgan, had a couple.
My old CEO.
Yeah, he had a couple, you know, comments at an interesting conference. He was talking about how their business is going really well. Trading is going really well. They're optimistic about investment banking picked up for some of the reasons that we talked about. M&A, there's been a lot. IPOs, there's a big backlog. But he is worried about the economy. Now, you could say that Jamie Dimon has been worried about the economy for a while, but when you think about the largest bank in the world and the access that he has to the largest companies in the world, to the leaders of the whole world, right? Like this, and I say to myself, you should probably listen to that. He's also not been buying back their stock in a while. He knows that at 3 times tangible book, you know what I mean? Like this is the most expensive this stock has ever been.
That's why I like regionals.
Okay, because you think they're a lot cheaper.
Yeah.
And you think with regulation, the way it might
they'll
be.
They'll benefit more.
And this is where I think options come in, right? As a retail trader, a $305 stock, you may not have the capital to buy a meaningful position. So going into the options market, one of my favorite strategies, Dan, is the poor man's covered call, right? Where you do a stock replacement. So instead of laying out $30,000 for 100 shares, I can go out maybe 5-6 months, buy a somewhat deep in the money option for much lower premium.
You buy a call that's a little further out.
Well,
so that's your long exposure,
I want that time. I want to basically take stock and replace it with an option. And so I find an option that's, maybe a 70-80 delta. I buy that. And then in the short term, I'm selling out of the money calls against it. So it's just like a covered call, but I'm using an in the money long-term option to replace the stock. And that gives me the exposure to a stock like a JP Morgan that's $300. Maybe I don't have the
yeah.
That's where you get that
the
leverage.
dividend it pays.
All right, let's talk. We don't have a lot of time here, but let's talk about some other sectors, Steph. So let's talk about Homebuilders. You know, they had this huge run. The anticipation of these rate cuts, you see the 30-year fixed mortgage come in. It was above 7% for a good part of the last year. We also know there's, you know, a weird supply-demand dynamic that has kind of plagued the housing market, I want to say, for 4 or so years.
Generational.
So there hasn't been a lot of movement. These stocks really had a huge run here. Have they gone? We had the question about sell the news on rate cuts. What do you think about Homebuilders? Have they gone too far, too fast? And maybe that is a sort of sell the news situation.
Yeah, I mean, I think it's a play on rate cuts. And, you know, there is not a one-to-one correlation between Fed rate cuts and mortgage rates, which is what matters more. That being said, we know that there's an undersupply. So there's a balance in that story, but I do think that it now reflects that supply story. And I do think it was a way for people just to take advantage of potential rate cuts. So I probably wouldn't be a big buyer here because it's already reflecting a lot of this. But I also think Meredith Whitney, we had her at Hood Summit last year, and she's been writing more recently about the expectation that she sees home prices dropping a lot in the next couple of years.
She's the one. She called the dividend cut in Citibank in early 2008. She had a lot of comments on home building. She's actually really close with Danny Moses, Vincent Daniel, and Porter Collins, the Big Short guys. They're going to be. They're here. Yeah. They're here. They're somewhere here.
They're here already.
And they're going to be on panels tomorrow. So check that out. All right, Obi. What's up with the Bitcoin? I mean, I look at Bitcoin, it's down 10% from its recent highs. I see gold up 10% from its recent lows. And so that sort of kind of bifurcation or that split between the nerd gold and the regular gold. How are we thinking about that? What are the customers doing? I know that crypto is a big part of your volumes here.
Let's do a little poll. How many people have crypto in their account? All right.
It's a lot.
That's about, I'd say, half the crowd.
Yeah.
How many people are crypto curious? How many people have never traded crypto?
What about gold? Anyone buying gold?
Anyone trading gold ETF, gold futures? Yeah.
A little bit. Yeah.
You know, I like to look at these from a technical perspective first. This is Bitcoin traded in kind of a long basing period. Tomorrow we'll have John Roque with Vinny Porter
I
or
love the
Vinny
basing
Daniels
stuff,
on.
yeah.
Bitcoin was trading in a base from a high of, we'll call it 108,000, kind of came down with everything in the market in the spring, reclaimed that and got up to new highs at just below 125,000, has retraced back to the top of that base. So trading in this range of 108 to 125, I mean, your guess is as good as mine, Dan. I think, gold is certainly trading at gold futures right now, December futures trading at 36.61. That's got to be near an all-time high.
It is, at least for the last 3 years.
So, we're near, this is a base and breakout too on gold
this
futures.
to me, like this recent breakout, to me is a reflection of two things. One is that Middle East tensions are rising a little bit, and I do think gold is like a disaster hedge. And then two, I think it's like this whole deficit thing, right? If interest rates are coming down, then gold it's not an income producing asset, right? So the lower interest rates are, it's actually like more helpful to own gold.
Yeah.
And so if interest rates here in the US have been coming down, the only thing is that like if our deficit starts to climb because we can't collect the tariffs, then.
Yeah, but everything, I agree with everything you guys just said about gold, but you could say almost all of those things about Bitcoin too.
Yeah.
And Bitcoin can't get out of its own way. I have a personal view about these, what do you call them? Treasury strategies, right? So Michael Saylor, MicroStrategy, now it's just called Strategy. He was selling everything that wasn't bolting down at MicroStrategy. He was selling equity, he was selling debt, he was selling convertible bonds, right? All that sort of stuff. And he was buying Bitcoin. And so the company or the stock became a proxy for basically Bitcoin, but a leveraged Bitcoin play. And it was trading at a multiple of really what it should have been. That makes no sense. I do think it's interesting, though, with Bitcoin over the last month or so come down 10%, MicroStrategy's down nearly 30%, right?
Yeah.
And these stocks, these strategies, if you will, they don't make a lot of sense to me. Before there was Bitcoin that you could trade on Robinhood or you could trade options or futures on the CME, that sort of thing, there was this GBTC. This was an ETF that had Bitcoin
Very
on it.
expensive ETF.
And it would trade it at a premium to the Bitcoin that it held. Then all of a sudden, when all of these other products came around, you saw it trade at a discount to the Bitcoin because there was a lot of other ways to kind of express those views. I think that's going to happen in some of these treasury names. I think there's a bubble in them right now. I think that bubble speaks to the sentiment that we're seeing in broader markets. And I also think that one or two of these is going to blow up. And it's going to be one of those situations that maybe it's not too different. One of these companies, but it might have similar effects that the FTX thing had, was at late 22 or so. So to me, keep an eye on these situations. Keep an eye on this divergence between gold and Bitcoin. Keep an eye on how many stable coins are being launched, because people forget Tether was a stable coin. Tether broke the buck 5 years ago or 4 years ago. And so to me, when I think about all these things, history doesn't always repeat, but it does rhyme. And I think there's a bubble in and around the sentiment in some of these cryptos. The meme coins, we saw this in 2021, right? And it was the ICOs in 17. It was the NFTs in 2021. It's going to be the treasuries. This is me, not my folks, my friends over here saying that it could be treasuries, it could be stable coins. Is that going to be destabling now when you think of the size, the market caps? Then the other thing, think about all these meme coins. You were talking about the executive branch. There's some people in Washington who are getting pretty wealthy putting these shit coins out there, all right? I just want to say that. And all these things, you look at the stock market, all of these things over my career, it's one of the reasons why there's only 3,700, publicly traded stocks. The cream rises to the top and the crap gets, flushed down there. So we got a minute left, Obi. What do you want to leave the folks here with?
Hey, we've got a ton of great education for you tomorrow. Make sure you check out all the sessions on the main stage. This stage will be active throughout the day. And then we're looking forward to seeing everyone tonight at Grand Prix Plaza for the big keynote announcement with Vlad, all the new products being announced. I haven't been over to the venue, Dan, but I hear it's amazing.
Yeah.
You guys are going to have a lot of fun. And then you guys see us walking around, grab us, ask us questions. And then don't forget, check out Steph and I every week on our YouTube channel. We do.
Give it to us. What is it?
It's The Week That Was. It's on Robinhood's YouTube channel every Friday, 4:30 p.m. Eastern. We talk for an hour. We have the live chat going, so you can hang out with us every Friday afternoon. We'd love to see you.
Thanks for listening to the Risk Reversal Podcast. If you don't follow it, go follow it.
Yes.
I mean, follow it there. All right, people. Thanks so much.